Hello everyone, welcome back to the channel. Matt with Green Bar Trading. Welcome back to another weekly watch list video where we go over everything you need to know for the week ahead in the stock market. So we're going to jump right into it. Hit the thumbs up. If you're new, consider subscribing. We have new videos just about every day. Now, I hope everyone had a great Christmas and a great holiday with family and friends. It was a nice 3-day weekend to just relax and enjoy everything that was going on. So, now it's Monday. The markets were closed today. So we have that last week left of the trading, 4 days. So 4 days left, and we'll see if there's a possibility to see that rally, that Santa Claus rally, as the kids say. Before we look into the charts, we have a lot to get to here. So I want to go over last week, the relative performance, what was popular, what was catching a bid last week, and that was energy. Energy had a fantastic week. The whole market in general was in the green, except for the technology and the consumer cyclical. All right, so that's basically what we've seen all year long. As we come into the end of the year, energy, 39% gainer on the year. The closest to that is utilities, just about 39% away, but it was up 0.56% for the year. So something that we said last January 1st, and I definitely plan on making a video next weekend, which will be it's going to be a weekly watch list video, but I'm also going to put in there what I like for 2023. And what we did in 2022, well, at the end of 2021, going into 2022, in our Discord, I posted that energy was going to be the single best sector to be invested in. And it blew away even my expectations. But that was a very good call, and I plan to do my homework this whole week, during the weekend. I already have some ideas in mind for 2023 and different trading strategies and techniques for 2023. So we're going to get into that all in our next weekly watch list video. But for now, just going over what we need to know for this week and what we saw last week with our economic calendar. That's where we want to start. So this was the sectors for the week. Now, looking at the economic calendar, what we saw last week, we had initial jobless claims and we had the real GDP numbers come in a lot higher than expected for Q3. At 3.2%, the economy grew. That is really, really good. That means that was a strong economy, a strong Q3. And that was the number that we saw. The market initially did not like any of this. And then on Friday, we got the PCE. This is something the Fed really looks at. And to be honest, it came in, everything was pretty much in line. So since it was all in line and there was no surprises, the market liked it. So this week coming up, we have nothing much going on here that's going to really move markets. The initial jobless claims, since it's, has to deal with the labor market, and that's something the Fed is really strong on, that has the potential, but there's going to be very low volume this week. Historically, these last 4 trading days of the week is called the Santa Claus rally, but there's very low volume. All the big money is not even paying attention this week. So that's the economic calendar. Now, I just want to show you guys the bond yields. Still a very big yield curve, inverted. you have the short dated here that have a higher yield than the longer dated. We've said this a million times. That's definitely the precursor for a possible recession that is coming up. Now, until we actually see a recession, because like I said, we just saw good GDP numbers, you need negative GDP growth for a recession to happen. So it seems to me like we're not very close to that happening yet. Consumers still have money to spend. There's still a very strong consumer labor market. All right. Earnings have gone up a lot. So we're still seeing a lot of money in Americans' bank accounts. In order for a recession to hit, they have to start feeling some pain. Now, there's been a recession in the housing market, but as far as everything else, everything's been pretty strong. Companies' earnings have been pretty strong. You see in the tech market, companies have to fire people, to keep that bottom line. But we haven't really seen that yet on a large scale, especially the services sector has not seen that. There's still people going on vacation, spending a ton of money, going out to eat. We haven't really seen that hit yet. When that does hit, it's going to affect GDP. So what am I looking at for GDP? I have up here, this is the GDP now, and in these videos, I like to teach you guys something that you might not see on other channels, you might not see in the news all the time, but this is the Federal Reserve Bank of Atlanta. They do a GDP, every week they do their updated GDP for the Q4. So that's what we're seeing here. It's the estimates out for the Q4. The Q4 ends in March, all right? So what they're currently seeing here is 3.7% GDP. That is really very strong market. That's a very strong economy. And this is up through a whole percentage point in just 3 days. Now, what do they look at? You can really dive in here for how they get this number, but how they came up with this 3.7 from 2.7 just 3 days ago is all these major releases that came out. And that one that I just showed you guys, that GDP from 12/22 in our economic calendar, that blew away expectations and was higher than expected, and the manufacturing and the PCE, the personal income, the new home sales, that even had better than expected numbers. So they change that GDP. This is the year that these economic releases are going to be so important. Nobody cared about economic releases when money was so easy, when the Fed was so loose with monetary policy. It didn't matter. They had interest rates near zero for so long. And that was the time to be buying very high speculative stocks, those high growth stocks, companies that weren't making any money. All right, that was the time to have bought them. Now things have changed. All right, you have a Fed that needs to bring down inflation. They need to make the labor market that is very, very tight to loosen up a little bit. They want to see unemployment go up. And if all that happens, you have the potential to see a recession coming up either, in 2023, 2024, who knows? But the bond market, like I've been showing you guys with that inverted yield curve, has definitely started to show that they think that there's going to be a recession coming up. So this is what this particular, estimates here from the Atlanta Fed, this is what they're currently showing for Q4, all right? So we're just about at the end of Q3, and that's the number that we saw on December 22nd. So this is forward looking here to Q4, which ends in March, all right? So I believe going forward that the market is just not ready yet to, show those cracks in the economy. We're still seeing a very strong market. So, a lot of people think that the back end of the year will be good in 2023. I just don't know if they have the right timing down. So, in order to cut through that timing, something that we like to do is we like to just use technical analysis, keep it simple, right? We like to look at market sentiment and some indicators and what we see in front of us here, and look back at past patterns as well to see, what we can possibly get in the future. It doesn't mean that if something happened in the past that it has to happen again. Patterns don't have to repeat themselves, but we've seen it happen, all right? And that's why we're looking at it. So there's a lot to understand. I understand that I gave you guys a lot of information there, but it is good to know how an economy works. It's even better to know how market sentiment works. And I'm going to show you guys, I've done this on our last live stream, but just because I know more people watch these weekly watch list videos, I want to show you how you can get economic data that is good or bad, and depending where the market is trading at, to see which way the moves are going to be. All right, in order to do that, I'm going to zoom in from this last low here in October. This is the S&P 500. So all this is the SPY. It's an ETF that tracks the S&P 500. It's that simple. It's just an index here. All right, for the year, downtrend. Okay, in October, we saw those June lows break, right? We had a CPI report on this day. Now, each one of these candles represents 1 day of trading, all right? So we got a CPI report that was very bad, meaning the report was showing higher inflation than expected. We sold off a whole bunch in the pre-market. You can see here, this level is where we were holding up. Pre-market broke that level. But when the market opened at 9:30 a.m. down here, we saw a lot of buying. Now, why would there be a lot of buying when we got a bad CPI report? Because we were already at the lows of the year. So you have to know what market structure is and where sentiment is. Since we were all the way down here already, the bad news baked in, RSI at lows, we saw a buying opportunity that led into, just about 2 months of an uptrend. We saw a nice uptrend here. Right there, we saw a nice uptrend. It was bouncing along, and then it finally broke that uptrend. All right. So sentiment was very low, even though the inflation report was showing higher than expected inflation, which normally would mean that the market would have sold off even more. But it happened in the pre-market. During the regular market hours, it got bought up. Same thing happened here. Now, this is really important. That's why I'm going over this. Right up here was a CPI report. It was a great CPI report. It was showing inflation lower than expected. The only problem is it was coming into this 4,100 level on the S&P. It was coming into previous resistance. It was also coming into, hang on one second. It was also coming into, on the year, this clear downtrend line. Very clear. But in the pre-market, it broke over that, right into resistance. The market opens at 9:30 in the morning. And since we were at already extended levels on the upside, market sentiment, everything else involved, you saw a sell-off during the day. So even with a nice, solid, positive report that we would want to see and what the Fed wanted to see, we still saw a sell-off. All right? So you need to know market sentiment at the time of these reports and how much is already in there already, and not get caught in a bull trap, in a bear trap. All right, you need to know market structure. And that's why I like to look at technical analysis, because even technical analysis here, that eliminated the noise of a bad report, of a good report. Technical analysis was telling me that the S&P 500 was coming into really heavy resistance, and we sold off. It was already oversold here. All right, you can see very clear that the market wanted to hold up at this level, and it did, even after a bad report. All right, so that's just the S&P 500. One other thing that I want to show you guys on this chart, because I do think that this is really important. This blue line here is the 20 EMA. This cream line is the 50 moving average. And then you have the 200 moving average up here, which has been basically rejecting the market all year long. All right. What I'm focusing in on is this blue line and the cream line. All right. Watch what happens here every time the blue line crosses under that cream line. I'm just going to circle these, and then we're going to go over it. All right. Look at the potential happening here. Okay. So when the blue line crosses under, we see a market breakdown. The blue line crosses under, the market breaks down. Same thing happened back here. The market breaks down. We're about to do the same thing. That blue line is about to cross back under that 50 moving average. Now, the same thing happens when this blue line crosses over the 50. You can see a nice rally, right? Crosses over the 50, we see a nice rally. Crosses over the 50, we see a rally, and, back into last year, same thing. So, this is something that I'm focusing on. This doesn't necessarily mean in the next 4 days this has to happen. All right, there's going to be low volume. I'm not sure where the market is going to go this week, but this is a very strong level here. So this 380 area, around 3,800 on the S&P 500, which is the SPX. Each time that we've broken under it, you can see right here very clear. So we broke under it this one day and just had a very nice candle. All right, this is a clear level, 3,800 on the SPX. This is the S&P 500 index. All right, that's a clear level that needs to hold up. If it breaks down, then you're probably going to see a lot more downside with this crossover of the 20 EMA, and you can possibly revisit lows. Now, the next 4 days of trading, we have historically seen, even during the worst times, and I'm going to show you guys here, we have to go all the way back to the tech bubble, where we saw sustained down years, because that's what this market reminds me of. All right, we saw in 2000, 2001, and 2002, the S&P 500 fell 10% in 2000. It fell about 13% in 2001, and then it fell the biggest amount in 2002. All right, we can just go see how much this fell in 2002. From the open was just about 25% down on that third year of the bubble bursting. So do I think that 1 year of downside on the S&P 500 is all we're going to see? I don't. I really don't think that this is just 1 year of a decline. Now, it might not be as bad as this first year was, but I'm just saying it could get worse. Now, if we were going to look back at the last 4 trading days, because that's what we're interested in, to see if there's a possibility of that Santa rally, even when the market has a bad year. So like I said, this year was down 10% back in 2000, but what do you see here? You see those days right here, 2020, 12, 26, 27, 28. You see some green candles here before the last day of the year, which was down a little bit. But you can see the volume was very low during these green candles. All right, that was during that first year of the downtrend. The second year, right here, the last couple days of trading, we can see the volume very low, like I'm telling you guys about, but you can see it's kind of held up. We didn't see a really big downturn, even though the market was down about 14% that year. All right, and then back in the last year, which was a really bad year, in 2002, the last couple days of trading, we did see some more downside. And this was down by the end of the year, 25%. All right. And then you saw in the first 3 months, the market was down before we went on the rally. And this rally lasted basically until the financial crisis in 2007, 2008. This is just the way that cycles go. We were in a huge bubble. To think that it would only take 1 year to unravel that whole stimulus, to unravel that whole bubble, it would be nice. I'm just not totally sure of that. So this is just me trying to show you guys something that you might not see on other channels. So you have 4 more days of trading. Where can we go? What I would be looking at is to make sure this 380 on the SPY holds up. I think that's pretty clear. So give yourself some room here. 378, 377, this area just to hold up a little bit. Now there's some stocks that I would like to show you guys that I have on watch, and we're just going to start here with Tesla. All right, let's go into the year. Now, I think everybody knows that Tesla has fallen off a cliff. I mean, really, really bad since, the peak up here at 415, all the way down now to closing at 123. It's just been very, very, very weak. The only thing is, and I'm not talking about next year, I'm talking about right now, possible, opportunities is a bounce. It's almost impossible not to see a bounce when the RSI is under 20. And that's where we're at now. Look at this selling volume. Just crazy. That's big money getting out of the position, possibly ahead of next year. So, can we see a retail little Santa rally in the next 4 days? I think it's possible. So that's why I have Tesla on watch. Now, catching a falling knife is never a good thing. But I think we're so oversold. Just looking at this sell-off without any major bounce is kind of rare. Now, we usually will see that RSI bounce. So that's something that I'm looking at on Tesla. Just trying to see if we could catch a little bit of a bottom here. Just about at this 121. See if it holds up. And maybe you could get a rally back into this trend line. And there's a good 20 points that's possible on Tesla. All right, now the next one I'm looking at is gold. All right. I feel like gold is ready to break out. And I'm going to show you some charts, some positions I'm even in on gold. The first one is a gold miner. This is Barrick Gold. Warren Buffett has been known to be to like this stock. And I see a company, I see a chart here that looks like it wants to break out. Very clear looking like this is going to break out. So I have my alerts set. It's consolidating here on a nice uptrend. looking for that breakout, and I have an alert set for that. The only thing is you have this down sloping 200-day moving average right up above, and that's gold. So I would be long this for the breakout. I think gold is also going to have a very good 2023. All right, now if you wanted to trade something that can move a little bit faster or give you some more range, it's NUGT. So nugget, all right? This is a 2 times the gold mining index. So this chart looks very similar to the chart that I just showed you guys on Barrick, and this will give you 2 times the move if you're interested in that. I mean, you can see here we had highs of 82 just back in April before it sold off. I think this one is getting ready to really make a nice move. So NUGT, that's going to be on my watch list. I really like gold coming up. Silver has had a decent year. It's actually up on the year. Also, like this one a lot to retest the highs here. I think precious metals are going to have a very good year. So that's silver. We looked at gold. GLD is also the ETF for gold. Very similar pattern. Looks like it wants to break on up to the upside. All right. So that's our gold. That's our silver. Now taking a look at Ford. This is also something I'm interested in. The fact that this didn't break June lows is a very positive thing. The only problem is you can see that this 200 moving average has been a nuisance. But that's fine because this is a low risk entry for a move back up. I caught this on our RSI scanners. That's how I got this. The last time it hit this scanner, it went from 11 all the way up to almost 15. Percentage wise, that's a very big move. All right, now I have an RSI scanner down here. And it's a very easy scanner to develop. Maybe I'll make a video on that looking forward. But I want something like this that is very oversold. A nice big company that has a low PE. I think this has the potential to set a base and maybe give me a move up. That's all I'm looking for. Just a small move up, and then I'll be taking profit on that. So that's Ford, and then I'm going to end with Apple. Apple is in that demand zone, all right? Same spot it was at before. We got told that there was going to be a lot of buying come in if it ever came back down to that. You can see the RSI is very low. This also hit our low at RSI scanner. And in these 2 days here, I had a nice long. So I got in down here and I sold up here. Now, I didn't catch the whole move, but then it came all the way back down. So this is definitely the type of market. If you're trading options, you're going to want to take at least some contracts off the table. Now, you might have a trade plan that says, you know, I want to buy down here in demand, and I'm going to want to sell way back up here. The only problem with that, if you're trading options, you're going to have that time decay, that theta that's going to eat into your profits. So what I would recommend is buying for a month, 2 months out. Buy something that will give you time to move. And you could always take some contracts off when it gets to that, you know, first spot or that profit target or a key indicator, something like that. But that's why Apple's on my watch list right now, as it's currently in demand. Now, if the new year opens up and Apple breaks down under 129, that's really going to pull the market down. This has a huge weighting on the overall market. So keep that in mind. Set alerts. If this breaks down, it could be very, very detrimental to the overall market. So I'm just going to set an alert down here at the 128s, at or below. I want to be alerted in case that happens. Now, I think the market in general will alert me because I'll look at a market that's down a whole bunch, and then most likely Apple will be as well. So yeah, so keep that in mind too. I hope that you guys enjoyed the video. I know it's a little long, but hit the thumbs up, and I'll see you back on the next one. Take care, guys.